Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's Thursday. It's April 6th. Where is the year going? We're in the second quarter already. It's about 7:49. The market's going to gear up to open up in about an hour and 41 minutes to be specific with you, and I like to be very specific with you. I went overboard yesterday. I went 20 minutes into my video, but I hope it was helpful. I wanted to educate you, teach you, and guide you. If you guys are liking these videos, post comments in the YouTube channel, like our Wealth Press YouTube channel. Go to YouTube, Wealth Press channel, and post comments under the video. I will actually respond. I watch them every morning, the comments, and I respond to them. Like, subscribe. And if you have any questions, you can always email me, support@marketgeeks.com. I actually care a lot about you guys, and I want everyone to do well. Now, let's talk about futures. As you can see here, Nasdaq is not having a great week, and I hate to say I told you so, but I told you that this rally is not going to be sustainable. The Dow's up only about 33 points. We did have a rally in healthcare stocks, and it looks like investors are shifting focus away from tech-heavy into blue chip stocks. We'll talk about it today because today is ETF day, top option in ETF. And ETFs are great because here's what you need to understand. Now, I don't talk about this a lot, but this is actually really important. The underlying stock follows the ETF that it's in about 70% of the time. That means there's a correlation between the ETF and the stock. So for example, if you see this consumer discretionary sector going down, there's a really good chance that about 70% of the stocks are going to be going down in the consumer discretionary sector. It's just how it works. I learned about this. One of the first things I learned when I started trading, and it was actually kind of a bummer because I kind of figured you can be right on the stock and you could still be wrong on the sector or the ETF that follows that sector, and you'll have a really, really big problem. So it's really important to gauge and make sure that the ETF, one of the 11 ETFs, and we'll go through them right now, to know which stock you're trading and what sector it's in to make sure that the sector and the stock are doing the same thing. Now, remember, I didn't say the correlation's 100%. I said the correlation's about 70%. So there's always going to be the 3 stocks out of 10 that are going to do their own thing. For example, look at GE. It's been just doing its own thing. But those are far and few in between. So 7 out of 10 typically follow the index. Now, notice the bond market. The bond market looks a little toppy here. It's down 4. Now, the Fed could go on a rampage and start saying things. And tomorrow we have a the jobless report, job claim report. Let me actually go to Econo so you could see what we're talking about here. This is the big report. Today we have the jobless claims. They're going to make a big deal out of this report, but I'm telling you right now, this is a no-brainer. This has been the most solid economic indicator since we started this business. Started the recession business. It's been very tight. It's been right around 200,000, and I'm expecting the 4-week moving average to come around. Now, if this starts going to 175, if this starts going to 165, that's going to be a problem. But 210, 215, 195, 190, as long as it's within the 4-week moving average, I think we'll be in a good position. So very, very, very much you need to understand that it's not going to be a big deal. But tomorrow, when markets are closed and we have Good Friday, oy vey, this employment situation could be a major, major shift because the ADP report is saying that earnings and numbers of employment is slowing down. Wage growth is slowing down. And if that's the case, and if it's reflected in the employment report, it may cause bonds to go higher. I don't think that's going to be the case. I think it's going to be fairly steady. But one of the reasons why the bond market rallied like this is because economic data has been coming out worse than expected. And when economic data comes out worse than expected, there's a gradual shift to not increase rates because the Fed was saying, well, job market is tight, so we're going to keep increasing. Well, if the job market is not tight, then they may have to back off. I don't think they're going to back off. And today, actually, James Bullard is going to be speaking at about 10 o'clock, and we'll hear more. But day before yesterday, Mester spoke, and she didn't seem to back off at all. But again, maybe I'm crazy. But I think this is sufficient enough, and I think the bond market's going to come down, and I think it's going to stay in the range. It could potentially go up to 110. It's happened before. If it does, I'm going to short the living heck out of it. But I think the bond market is overdone, and seasonally, by the way, bond market comes down over the next several days. So there's a high probability that bonds are overbought. Also, you will see right here, notice the overbought level, we went straight down. Notice the overbought level It looks like we're going to go straight down. We'll see. We'll see how the economic data looks and what Bullard has to say. I'm just nervous about Squirrely, A.K. Powell, but he's not talking today. Now, if this happens, if this goes down, just want to bring this to your attention. It's going to put a very, very nasty sentiment to the Nasdaq market, which has already been doing that. So again, interest rates going higher, which means bonds going lower, puts more pressure on this Nasdaq, which I told you was overbought, because when we went to the sectors the other day, just to give you a little review, and we looked at information technology, which is now at 58%. I just want to show you something. Look at where it was just a few days ago. Now it's at 57. It went to 100. Oh, yeah, it's like that. And I warned you, and this happened not too long ago. It happened less than a week ago. And I told you this was going to happen. So we're seeing a cool-off. Not just infotech. Look at consumer discretionary. Look at that. It was up here. Now it's down here. I drew this line right when that happened. And if you want, you can go back and watch my video. But it literally happened to the day. And also communication services, which are still up there, which I think will have to drop. They're still up there, but I'm telling you, look at the stocks that are in the communication sector. It's called communication sector. Why, I have no idea. But if you look at the constituents, you will see you got Meta, Alphabet, Netflix. These are tech stocks. These are tech stocks, folks. I mean, don't fool yourself. So if the bond market starts coming down, interest rates go up, it'll put a hamper on it. And by the way, this sector is just grossly overbought anyway, because you could see, based on the sentiment, look at where we're at right now. I mean, do you really think the market's going to go higher based on this? That doesn't look very pretty. That looks like the market needs to cool off. So, and also remember, if the tech really comes down, it's going to knock the Dow and all those stocks off. Now, let's talk a little bit about the economy so we can get into the nitty-gritty and go through the sectors. 3 major U.S. benchmark indices ended the regular session mixed, as weaker than estimated economic data fueled worries that the Federal Reserve's rate hike campaign could push the U.S. economy into a recession. That's why interest rates are not going, that's why bonds were going high, because if there's a recession, Fed is not going to be doing anything. And also energies would go down. There's a huge difference between a recession and a worsening economy and inflation. Inflation, certain assets go up. Recession, dead meat. So while investors focus on Friday's report, which is coming out Friday morning. It's coming out Good Friday when markets are actually not open. That'll be really interesting. In Wednesday's sessions, yesterday's session, tech-heavy Nasdaq underperformed major benchmarks as investors shifted from growth stocks to defensive stocks following weak U.S. economic data. Now, economically sensitive industrial stocks also weighted on the broad market as investors worried about potential economic downturns. But what went up was the healthcare sectors, which really projected the Dow higher. Remember, healthcare is not dependent as much on the economy. It's dependent more on government. So because there's not a lot of public money, as much public money going into healthcare as technology or other sectors. So you have a shift moving from technology-heavy stocks all the way into these healthcare stocks and so forth. ADP National Employment Report showed Wednesday that private payroll increased by 145,000 in March. That's a very sharp decline from 261 and below economic estimates of 200,000. It'll be very interesting how today's jobless claims and Friday's employment data, whether it'll reflect it or not. It's a hit or miss with ADP. It really is. Also, non-manufacturing PMI slowed more than expected. U.S. trade balance came in at 50 billion in February, weaker than expected. So business activity is not doing all that great. Meanwhile, 58% chance of a no rate hike based on what we're seeing right now in the market, and 41% of a 25-point basis hike. This has gone back and forth already, probably 3 times since Mr. Squirrely himself has spoke. So the market does not believe there's going to be a rate hike, but let's wait and see what the Fed has to say. Speaking of the Fed, Cleveland Fed Loretta Mester said Wednesday, policymakers would need to raise interest rates a little bit higher. You hear that? A little bit higher to tame high inflation. We certainly are focused on inflation and making sure that inflation gets back to 2% over time. So from where I'm looking, I just don't see them taking a different action. Meanwhile, International Monetary Fund warned Wednesday that global tension between China and U.S. could damage overseas investment and eventually lead to a long-term loss of 2% of global output. This is why we watch China so closely. Today, we're watching the initial jobless claims. It should come out right around 200,000. If it comes out like 175, 165, I'll be worried. If it comes out normally, not going to really care too much about it. In addition, we're going to hear from Bullard. I want to hear if he echoes what Mester said, or if he has his own agenda. But I don't think he will. I think he's going to do exactly that. Europe, gains in real estate and travel stocks led the market higher, which is great. China ended flat as a flare-up in U.S.-China tension overshadowed fresh evidence of economic rebound. And a strong rally in artificial intelligence and semiconductor stocks capped losses in China, which is a good thing. But again, there's a lot of tension between U.S. and China right now. At the same time, the Nikkei stock closed lower, hitting more than a one-week low as the strengthening yen weighted on export-oriented stock, while heavyweight chip-related stocks tracked the Nasdaq nastiness of the Nasdaq weakness. As far as news, AbbVie, it's a healthcare stock, 1% less in pre-market, lower guidance. FedEx did pretty good. Goldman Sachs reiterated their price target. And we have earnings today on Constellation Brands, Lamb Weston, and Levi's. So keep your eye on that. That's going to be very, 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 very important. Now, looking at the sectors, technology is still leading. Communication services are still leading. But look at consumer discretionary. It's coming down, and I think it's going to come down even further. Matter of fact, if you look at the last month, you will see that communication services is actually overshadowing technology, but look what's in second place, and look what's in third place. Now, do you think utilities and consumer staples have a lot in common with technology and communication services? No, they don't. So I'm expecting these to continue cooling off. In terms of what to expect, I think communication services is going to come down. I think we have a little more downside in technology before this is done because momentum levels are still, where. Utilities looks like it's on a rampage because a lot of money went away from communication and technology into utilities. Consumer staples is still looking pretty strong. I like that. Real estate looks like it might have had it. Energy looks like it's still doing pretty good. Consumer discretionary looks like it's going to come down. It couldn't take out this high. And healthcare is on a roll. Now, notice utilities and healthcare, the two sectors that are least impacted by the economy. And remember, utilities rise when interest rates go down, and interest rates have been going down. So the fact that bonds may come lower means higher interest rates, and if higher interest rates, it may push the utility sector down. So something to keep in mind and something you need to pay close attention to. Industrial sector looks weak, looks like it's got more downside to go. Basic materials looks like it's a big question mark, and financial looks like it's just kind of choppy. My humble opinion for you guys, in my humble opinion, I would clearly go with consumer staples because they're inflationary, they're defensive for inflationary, and they've been on a good roll lately. So XLP would be the sector that I would go through, and just to give you an idea, it looks like it's breaking out quite nicely. Almost at swing highs again, which is very, very impressive. You may want to wait a day or two for this to cool off a little bit. I mean, from 74 to 75, but it looks like it's got more momentum. If I were you, I would be going all the way out to the 71 days out, and I'd be going to about the 75, 76 strike price. Don't worry about the options right now, the bid and offer. It's going to get nice. Look at the liquidity here. There's going to be a spread of like 5 cents when it opens, and give it a little time. But 75, 76 strike price, they're not expensive. Give yourself a little time and maybe wait till next week. That's my suggestion. Implied volatility is not that high, but give yourself a little time. Holiday, markets are fragmented right now. Usually when it's not a full week, they're fragmented. Let's start off next week with a Tuesday with a bang, or with a Monday with a bang. And meanwhile, I've got something for you. I'm getting ready to go live at 1 p.m. Eastern time for an urgent briefing before the markets close. It's going to be great. The Fed has been toying with the market all year, and now they're pivoting. That's right. In the past 2 weeks, $400 billion has been injected into the economy. And because of this move, a rare buy signal is flashing on one group of market-leading stocks. During today's presentation, I'm going to reveal how to potentially capitalize on the explosive returns we could see after interest rates peak out. Now, we'll see. I mean, we'll see what happens. Follow the link below. You want to get into it. This is going to be eye-opening. You guys are going to have a great time, and you don't want to miss it. Remember, like my channel, subscribe to the Wealth Press YouTube channel, watch my videos, give them a thumbs up, and comment. Comment. Good, bad, ugly. I'll respond to you head on. I'm doing the best that I can, and if you guys are gaining value out of this, send me an email, support@marketgeeks.com. I want to hear from you. Bye, guys. Have a great long weekend, and stay out of trouble. I really mean that. Stay out of trouble. I'm going to have to make sure Clyde stays out of trouble, and Bonnie. Bye.